Okay, let's get started. I promise that given how the first class went, if we stay on task, we'll get out of here early, which I'm sure Saturday night you guys would all appreciate. So, cool. So today, what we're going to do is we're going to do a review of like last class. Obviously, was a lot, so we're just going to do some quick review of the key concepts, and then the review will be focused towards basically the first homework. So what I'll do is I'll just sort of go over the first homework, and then I've also attached like a sample homework from last year. We won't go over that very much, but basically just the next half hour or so of review, I promise you, will be somewhat useful. And then we'll take a break, and then we'll start on back testing, which basically we're going to start talking about how to put together a back test. Not just what is alpha, but how exactly do you put together a back test for a strategy, which then you test for alpha. And then so today's lecture, the material we start today will basically span into next class. And so we probably won't get to actually coding up a strategy, but at least we'll talk about all the steps to get there. And then next class will just be coding. So, and then we'll actually go through it. Just some announcements for those of you guys. So last time I announced that there was like WRDS access, and the librarian finally confirmed it. So for those of you guys who want to download the data in this class in its rawest form, we actually subscribe to probably about 30 different data sets that it changes from year to year. No school has them all. It's just whatever the faculty want for their own research. But basically, we have a bunch of different data sets that we won't use in this class. So if you guys just want to hoard data sets for your future data science, or just because you're a hoarder, you can basically go on that website and then download everything that we have. Also, some of you already joined this, but it wasn't, the QR codes weren't in the original slides last time. But basically, we started a WhatsApp group and WeChat group. So I think the WeChat code expires in a week. Is that how that works? So I guess just scan it now. I guess this is the WeChat one. That's the WhatsApp one. I'll monitor both, so you can choose to go into either or both or whatever. And it'll just be for the class. And then we stick to this because some people who use WhatsApp don't use WeChat and vice versa. So there's no preference. Yeah, so it's in the slides. Just do it now, or I guess in the future we can just create another QR code or something. Okay, I still see some phones up, so I'm just gonna leave it there for a second. Okay, so basically what I wanted to get after is this idea of what exactly is alpha and what is outperformance. And basically the idea behind that was there's a little bit of economic theory, a little bit of a sort of economic history behind it. And this debate that informs the reason why we have alpha and beta as statistical tests also comes up often when people talk about like what exactly is the reason why economics, what are the economics behind strategies? Like, in other words, like, why is it that this strategy works? And so it's good to get a sort of handle on the economic foundation and the theoretical foundation of these things. Basically, the fundamental premise of everything is understanding whether or not markets are efficient. So there's a big debate that if markets provide people the opportunity to invest, then are they efficient at aggregating information? And the reason why efficiency is good is because we definitely don't want stocks to be overvalued, but I would prefer all the stocks to be undervalued, and then we'd all become millionaires. But I guess one thing that people were concerned about is if companies don't have fair pricing and things like that, then if an overvalued stock to us, I should say what we think is undervalued, right? For example, would just mean that a company doesn't raise enough capital to invest. So what we want is actually fair pricing. And so people were always interested in this idea: is are markets efficient? And then in order to test that, we basically wanted to see if most assets basically offer the same return on risk ratio. So some assets offer higher returns, but then we would then expect them to have higher risk. And so this idea of return on risk. And so basically, if you believe markets are efficient, then the only explanation for why there's a positive return is that there is adequate return on risk. If it offers a higher return, it must mean that it's a more risky asset, right? The alternative is basically that things are mispriced. So the mispricing could be temporary or it could be permanent. Temporary means that, oh, maybe this, this month, this period, this year, the stock is undervalued, but eventually markets will catch up. And if you use the same strategy over the course of time, you can't expect to beat the market. Everything will have the same return on risk ratio eventually. A permanent or systematic mispricing would mean that you can actually continually do this month after month, year after year. And we don't really know which world we're in. It's always going to be a debate. The explanation will always be something like, well, there doesn't seem to be a risk factor that you're being compensated for, but you haven't seen all the bad things that could ever happen. You haven't seen, geopolitical risks, are sort of like this new thing that have sort of come up in the last few years. Anyway, the point is that it doesn't quite matter. It's sort of like a philosophical debate, but the idea is that these are sort of the two explanations. And the reason why people really cared is because, we in general want prices to be efficient. And so how do we even test that? Well, then we basically have to take some stance on what people should think is risky. And so one thing is that if we're all invested in the market, I think we can agree there's one common risk factor, which is that the market itself may crash. And so if you're scared of risk, then you don't want to hold an asset that is high covariance with the market, because obviously if the market crashes, then your wealth falls. So if my beta is 1, that means when the market crashes by 20%, I'm going to lose 20% of my wealth. If my beta is 2, that means when the market crashes by 20%, I'm going to lose 40% of my wealth. And so presumably, in order to hold the asset with a beta of 2, I would need to expect higher returns, this idea of higher expected returns. And so the only reason why over a 20, 30, 40-year period, over the long run, this asset would return what it returns is because at some point, the investors who invested in it must have thought it was really risky, else they would have bought more and bid up the valuation and thus lowered the return. So people are, what they try to do is they try to test whether or not things fall on the security market line, meaning that is it the case that if you write down a risk factor, such as the market risk, that the return is in general proportional to its market beta. And so this is like sort of the way we decided to write this down. And a rejection of this model is basically that there exists a bunch of different strategies, a set of strategies that were systematically over time, you can essentially reject the efficient markets hypothesis by finding that there's positive alpha. There's a strategy whose return doesn't seem to be explained by risk. That's all math. Many people are allergic to math. I personally am allergic to math, so let's do it in form pictures. Basically, what we expect is everything falls on the security market line. There's obviously a straw man. And in general, we know that this is probably not true, or else there wouldn't be so many hedge funds in the world. So, but this is a starting point in 1970. We needed some way of formalizing this idea of the efficient markets hypothesis, which like 60 years ago, of course, was sort of this new novel concept. So what we're looking for in this class, right, is things to not fall on the security market line. We're looking for things that fall off the security market line, right? And so specifically, there are things that fall off the security market line, which we want, and things that fall, and things that we don't want. What we don't want, and this reflects my bias towards specific types of characters, we don't want to be, where Jigglypuff is. We don't want to be where Minions are. We don't want to be where this Ninja Star is. What that is it says that if you trade in this strategy, given a level of risk, you'd have lower returns than the security market line, which means you should just invest in the market portfolio. Okay. If you are anywhere where those characters, which I like, are, then you have higher return relative to risk. Okay. And of course, this assumes that this is a single factor model, but you could replace the US market portfolio with whatever your preferred benchmark is. It can be multi-factor. But basically what we want, ideally, is something above the line. Now, do we want to be where Pikachu is, Yoshi, or Pac-Man? That's really your own risk preferences, right? So that's really up to you. That's dependent on your portfolio constraints. If, for example, a pension fund hires you to be a smart beta manager, a portable alpha manager, they would expect you to have 0 beta, right? They would want you to be a little bit Pac-Man to the right. And basically what they want is zero beta and high alpha, right? If it's me, I am not a pension fund manager. I'm looking to get market exposure because the market risk premium is excellent. It gives you consistently, 6% above risk-free per year. I would probably want something like, I'd actually probably want Pikachu. So the standard thing that a lot of people don't do is they do the standard thing that people say in the news is like 80-20 stock bonds or 50-50 stock bonds or something. I'm of the opinion that for young people, and this is my personal opinion, it's not financial advice, you should actually probably lever up because you don't really care from year to year, right? If your portfolio drops because you're not going to retire next year. But anyway, so I personally would probably be where Pikachu is. But basically, whether or not you want to be Pikachu, Pac-Man, Yoshi, or whatever other character, you want to be above the line. And then basically everything else is just your personal choice in terms of your risk preference, your investment mandate. We want positive alpha. So the way we decided to test whether or not assets have positive alpha and the terminology of positive alpha and market beta comes from the idea of running a regression. In a regression, basically what people have done is they want to estimate relationships between variables and data. So what they do is they plot data, right? And then basically there's this model that's typically formalized as y equals alpha or beta 0, but alpha plus beta 1, x1, x1's a variable. So in this case, it'd be the returns to your strategy. X1 would maybe be the market risk premium. And then basically what we would do is try to fill in what these numbers are by basically asking a computer to say, okay, if you plot the data this way in the univariate case, basically what does it look like, right? If we drew the line of best fit. The line of best fit minimizes the sum of squared residuals, blah, blah, blah. But basically alpha says if the market did not move at all, or if the market had zero return that month, what would be the return to the strategy? So there's this thing. So for example, if I had a beta neutral portfolio, the alpha would be my monthly return month over month, assuming it was a monthly regression. And then the beta would be this line, the line would be flat. This is clearly something that has positive market beta, right? Because the line is upward sloping. That means the y-axis is return, the x-axis is the market return. When market return goes up, my portfolio return goes up, right? And so that's basically the idea. The line, we estimate whether or not there's a positive alpha and what the beta of my portfolio is by drawing a line through a cloud of data. And so to give you guys an example, and this can be a multi-factor example, we talked about my dad. My dad's a honky. My dad only thinks these three markets exist, right? And so, I mean, this is literally the markets he would trade. And basically, he would probably invest somewhere in the US, somewhere in Hong Kong, and somewhere in Europe. And basically what a regression would do, we would say, okay, let's take a look at the total dollar weighted return of my dad's portfolio, plot, and then basically assess how correlated, what is the covariance between these different markets in my dad's portfolio return. And then the regression would fill in these numbers. It would say, okay, well, on average, my dad's portfolio is such that when the market goes up, the US market goes up by 10%, his portfolio goes up by 2%. When the Hang Seng Index goes up by 10%, his portfolio goes up by 8%. When the European market goes up by 1%, his portfolio goes up 10%, 1%. But when you plug in what those numbers are historically, nevertheless, my dad outperforms by 2% per, I guess, month. If he could outperform by 2% per month, he's like the best trader in the world, then you should start a hedge fund. But I am sure my dad's alpha is not positive. And it's not nearly this order of magnitude. Thankfully, it's not negative 2%. So I'm somewhat convinced he overtrades. But anyway, the point is that a regression fills out this number. You have to basically plug in your benchmark assets. Your benchmark assets depends on what exactly you're trying to do. So for my dad, this is probably what he would normally invest in. If you're testing the CAPM, you just care about the market portfolio. If you're an institutional investor, you probably have different factors. You don't want to just access equity markets, but you maybe have some benchmark factors. So maybe what you put in here is like the hedge fund index, the private equity index, a real estate index, so on and so forth. It sort of depends exactly what you're trying to do. And what's useful here is basically it tells you what is in your portfolio. So my dad may not own 80% in the Hang Seng Index, but whatever he does, it behaves like his portfolio has a 0.8 exposure. So it could be that he has a triple X levered ETF. that basically he has, let's say, 8/3, what is that, 2.4, 2.5% in. And therefore, he has like a, maybe he has 25, 26% exposure in that ETF, but has 3x exposure to the market. So his portfolio behaves like 0.8. I don't know what it is, but this regression is going to tell you what his portfolio behaves like, but then also, how much he outperforms or underperforms with respect to that. Okay, so this model then gets translated to numbers. You can do this in Excel. You can do this in one-line encoded Python. It's like the oldest statistical tool, one of the oldest statistical tools that we have. And so this is where the term market beta and alpha come from. So this is important, but it's also, we already talked about it. And then this is where we ended last time. Again, this is review. We talked about QMJ versus the market. The graphs look a little bit different because I made them in R, which is much superior language. But anyway, the market risk premium against the QMJ. And remember, QMJ is a strategy that is like the Warren Buffett strategy, which buys safe, meaning high quality assets, and shorts junky assets, which are high dividends with low leverage, high sales growth. There's a bunch of factors that basically sound good and sound safe. And basically, they combine them into an index and then just buy those stocks. And basically, given these two assets, it's not super clear, which one we want. On the one hand, the blue one is safer. On the other hand, the red one has much higher total return, right? So it's not clear which one we want, right? And of course, you can maybe lever one up, you maybe lever the blue one up or whatever. It's not clear which one we want, right? So, but there's something better. Under certain conditions, we can actually turn them into a superior portfolio, but not in all conditions. So how do we know we've met the conditions where it's worth it to add QMJ to my portfolio? And that's where we get to this idea of alpha. And so when we ran that regression, we found that if we regressed QMJ against the market, which is my benchmark portfolio, then we found that it had positive alpha and a small beta, albeit slightly negative beta. How can you have a negative beta? This one, I don't think was obvious that you would have a negative beta because both of them go up over time. So if both of them go up over time, wouldn't you think they're positively correlated? That's fair enough. I actually didn't expect that they would have a negative beta, but empirically, the way they have a negative beta is that, remember, when the market drops, the blue line goes up, the market drops here, the blue line goes up. And so there's some very specific episodes of market history where the market tanks and QMJ seems to actually go the opposite way. And so maybe that's where the small but negative beta comes from. But I didn't necessarily think that they were necessarily negative or positive, but that's just what it is. And so one interpretation of that, which a student brought up last time, which I also agree with, is if you ever read Bloomberg, there's this idea that the US is a safe haven. And when equity markets globally fall, the US dollar tends to rise. And why is that? It's because people want to dump the risky asset and plow into, and on a relative basis, the US is safer. And so therefore the US dollar rises. And so within US equities, it might be something similar where there's a flight to quality within stocks. It might be true, it's testable, but that could be one rationale, right? So maybe when the market crashes, people dump the risky stocks, they buy the high quality, high dividend paying stocks. And so that could be one explanation. But nevertheless, you can see that there's a slight negative beta. And then actually there's this huge positive alpha. That's what the constant term means. And what the constant term means is that if you had a zero beta portfolio, on average, on a monthly basis, you'd earn 50 basis points, meaning you'd earn 7% per year. Now, that's actually the size of the market risk premium, right? But we actually end up in a place much lower than the market risk premium. Why? It's because it has a negative beta to the market tends to move up. So one way you can think about it is that the alpha would give you 7%, but the beta would be would basically say it's let's say the market risk premium is 7% or 8%. Let's make the math easy. If the market risk premium is 8%, this negative 2.25% beta means that you're on, you can basically expect that every year your market beta costs you 2%. But if you were zero beta, you'd only earn the alpha. Okay, so that's basically why, even though this is roughly the size of the market risk premium, you actually end up below the market because you're basically your return is being dragged by your negative covariance with the market. I don't know if that makes sense, but basically the idea is this is roughly the size of the market, but the market, it's also negatively exposed to the market. Market tends to go up, which drags the return down. But basically what this means is if you draw it in like, let me just draw it. Actually, no, I think I have this. Yeah, no, that's what I was going to draw. If you draw it, then the question is, where are you in this space, right? So first of all, are we above or below the line? Above or below the line? Good. Okay, cool. Awesome. Thank you. At least some people didn't go to happy hour before class, which is good. Okay. Are we to the right or left of the y-axis? Good. And why is that? It's because your beta is negative. Okay. So that means we're probably where Pac-Man was, right? So you guys probably don't remember. I remember. It's where Pac-Man was. Okay. So we were where Pac-Man was. Okay. What is the expected return of a negative beta portfolio? It would be, if you drew this line out, the expected return of a negative beta portfolio would be the risk-free rate minus beta times the market risk premium. So actually, you would expect a return here. The alpha is the difference between Pac-Man's mouth and basically the projection of the risk-free of the security market line. So that's why we have a positive alpha. But note that this the total return is actually below the market risk premium. So that's basically what I'm trying to say with why you have a slightly that's why you have positive alpha, but yet a return that's lower than the market risk market return. Because the expected return from the security market line is down here, so you're somewhere between the market risk premium and the security market line. The reason why I'm explaining this is the student had a question last class: how is it that you can have positive alpha but a lower return to the market? And that's because the alpha is the difference between the line and the projection of the line and where the average return actually is. Anyway, so when you put it in your portfolio, basically it's like magic. And so basically the argument is that if you have positive alpha, by definition, there exists if any of you guys are actually interested in the mathematical proof, I actually asked one of my friends to prove it, and then it's actually provable that if your goal is to optimize return and minimize, if you're a mean variance investor, you're trying to optimize return and minimize variance. If you have positive alpha, there exists at least one portfolio where an asset with positive alpha increases your Sharpe ratio. In other words, it either increases your mean return or reduces your variance, such that a mean variance investor would prefer it. If that sounded like basically hocus pocus to you, basically positive alpha means you can find something that's good, is basically the idea. Whether it increases your return or minimizes your variance or both is really an empirical question subject to the properties of that investment. But here what you can see is that when you put the green line and blue line overlaid 1/2, I'm not saying that's the optimal portfolio, you can see you get the red line. The red line is the same line as the green line, ends up roughly in the same spot. But it's clear that I would prefer the red line because the red line is a lot smoother, right? So I think almost all of us would prefer the red line. And you would have probably somewhere the total return at the end, where you end up. So for sure the variance is lower. Whether you end up close to the green line or blue line just depends on your portfolio weight. So if you went 1/4 QMJ, 3/4 market, my guess is you would end up above the green line, but a little more volatile. If you were 3/4 QMJ, 1/4 market, you'd probably end up even smoother than the green line and then the red line, but probably closer to the somewhere between the blue line and the green line, right? So it really depends on your portfolio weight, but it's really up to you what risk return ratio you want. So in the end, all I'm trying to say is whenever you have positive alpha, you can find at least one portfolio that if your back test looks like the future, you will definitely be able to improve your portfolio. And if you guys are interested in the proof, I literally have it, although I'm sure most of you don't care, but like literally you can prove this. And so this idea of watching your money grow, benchmark alpha, and improving your Sharpe ratio is basically how everyone does it. Not just academic nerds, but if you read a bunch of industry papers, this is from I don't know where these are from. I don't know where the left. I don't exactly. I'm not that familiar with the left one, but the left one is a company that basically sells machine learning signals. The one on the right is a company in Cyberport. My buddy Vinesh, who basically sells. He has like many dozens of hedge fund clients. What he does is he sells alternative data trading strategies, and basically the entire industry, whether you're on the sell side, whether you're selling signals, whether Citadel was here 2 years ago, and all they talked about was finding CAPM alpha. Literally, this is how the entire industry works, right? And so this is the most important concept, whether or not you are a fund, at a fund of funds, and you're trying to evaluate whether or not adding a new fund manager is useful to your family office portfolio. It's important whether you're a quant researcher. It's important, in general within the asset management industry. This is basically the way in which people typically evaluate performance. Okay, so you just got to make sure that you understand the core concepts of why these things are important, and how to interpret these outputs, because this is like literally just how all the quantitative finance, whether you're doing exotic stuff like alternative data machine learning, or whether you're just doing more simple portfolio management, everyone talks about things in these terms: Sharpe ratio, alpha, covariance, exposures, market betas, benchmark betas, right? And so you have to understand these basic concepts. And so we won't review last year the code because that's boring and it was really simple. But what I wanted to do was at least sort of show you guys the homework. The homework, I think, does anyone have any questions at this point about any of the material? I just like talking, and I don't know. Okay, so I just wanted to say that I think this is the most important concept. It's also not that hard of a concept, but one has to be quite subtle with it. It's quite subtle. So what I wanted to do was just say, look, like, I've put last year's homework in here, and then I've also put this year's homework in here, okay? And I also put out a worked out solution. And basically this year and last year, they're conceptually similar, but of course I changed the question since I'm also giving away last year's answer key and so on and so forth. Sorry, let me just log back into my server. I just wanted to show you guys one thing. This computer's so slow, sorry. Okay, so I put out last year's homework and last year's answers. So the original form, and then I also put out this year's homework, and they should be in your course folder. And basically, the thing I wanted to sort of highlight, first of all, this is basically how I distribute the answer key. You're welcome to answer it in these terms. You can make a slide deck if you want, or Microsoft Word. It's not me grading this time, so I mean, whatever. Not my problem. No, I'm kidding. But basically, what I wanted to sort of get across here is that what I tried to do last year, and so I guess there are two reasons to understand this. One is obviously, I don't really care how you guys, it's not me grading, but then in general, it's not, I don't really, when I do grade, basically it doesn't matter to me how you present it, as long as it's clear. So what I did in this answer key was basically answer the questions in, I think, the simplest way possible, right? And so many people submit Jupyter notebooks. You can do a Word write-up, PowerPoint, whatever. What I did last time were questions that are analogous to the ones this time. So the first questions were about basically facts about the market. And so last year, I just asked people to calculate the market risk premium, the numerator and denominator to the Sharpe ratio, and then basically do some compounding math. And so the idea was that just make sure that people understood basic financial properties. There's a basic question about how to interpret a factor regression. It's very simple. and then some conceptual questions about what does it mean, some backtest things like what does it mean for a backtest at positive alpha? Why does momentum exist? Momentum is a strategy that we'll talk about today. And then so the idea is basically just, these are questions that I think sort of give you a sense of how I think one should answer these questions. And hopefully the questions are unto themselves a little bit informative. And then basically it gives a lot of sample code for how to run factor regressions and things like that. So last year, I tried to come up with a question as interesting this year, although I think last year my question was more interesting. Have any of you guys heard of Cathie Wood, ARC ETF? Okay, yeah. So my uncle and cousin in Hong Kong, all they talk about is Cathie Wood. And then basically what I did last year was there was because my uncle and cousin were talking about it around right before Chinese New Year. I was curious about her because if you read articles about Cathie Wood, they say she's the next Warren Buffett. So what I did was then I compared her to Warren Buffett. And so the idea of this assignment was to say whether or not she's the next Warren Buffett. So what I did was I took ARC ETF's return, and then I took Berkshire Hathaway's return. And then what I asked people to do was basically compare them to the standard factor models that we have, the Fama French factors, for which we'll obviously explain later, as well as industry portfolios. And what you find out is that, first of all, Cathie Wood, according to standard risk factors, has like no alpha, but also that she behaves nothing like Warren Buffett, which is not to say it's a good or bad thing. I think Warren Buffett used to have alpha, but actually in recent periods, he actually has no alpha relative to standard risk factors. But basically, this is sort of, I think, an informative exercise. And so you have a lot of code here, and then also written explanations for it that I hopefully reduces the ambiguity about how one should answer these questions. But also, hopefully, at least you appreciated this question because I thought it was really fun to go through. Anyway, this I think if you can do this homework, it's pretty much similar to this year's homework. And I just want to sort of just quickly show you guys that, and then we can sort of just so I mean this year's so I put this year's homework also in there. So basically, the first question is about facts about returns. So last year, so what I wanted to emphasize this year is because all of you guys have GPT now. So less coding questions, more conceptual questions or whatever. Otherwise, and actually, I don't know if GPT could just do this question. You guys are welcome to try, but please don't write in your answers as an AI, blah, 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 blah. Like at least edit it. Last year, there was one person who I openly permitted GPT, but basically the answer was like literally like, you ask a wonderful question, blah, 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 blah. It's like, yeah, I was just like, oh my God, this is so dumb. But, and actually what's funny is that some people claim to use GPT because I was like, how did you get this answer? And then it's clear that GPT wouldn't do it because GPT wouldn't be that dumb. But anyway, so again, I don't care. You should just write whether you use GPT and I don't care. But hopefully this is a little GPT proof. When I ran it through GPT, but I didn't bother prompt engineering, it wasn't able to answer it perfectly. So anyway, basically what I'm trying to emphasize this year is just knowing more facts about finance, because one of the things about finance is that there's a lot of people who have technically no skills, but they know a lot of finance. And they're still very valuable because finance is a little bit of a game about domain knowledge. It's not just raw technical IQ. So there's this guy at NYU. His name is Aswath Damodaran. I probably butchered his name. Whatever. Anyway, he's very famous. He's an NYU professor. He's famous because he's very outspoken about market things. And in particular, he puts out two data sheets that a lot of industry guys watch. First, what is the global equity return? Second, what are asset returns of various asset classes? So we're going to study the first one. And the reason why I was particularly interested in this problem is because, so this quant trading class is a little bit of a, sometimes I get interested in problems because things that happen in my life. Like for instance, last year's homework was because my uncle and cousin were obsessed with Cathie Wood. This year, when I went back home to LA, my dad kept telling me to buy a house. And I was like, no, that doesn't make any sense. I don't think housing returns are that good. So I was just curious. And then basically what I did was I found this guy's website. What he posts is equity returns in the US, government bond returns, corporate bond returns, and housing returns. And then so maybe you guys can also learn facts about these different asset classes. And there's a couple questions about calculating basic financial math. The last one is about forming a better portfolio and just basically walking through this idea of improving your portfolio. And then the last question, which sort of reconciles why why I don't think I want to buy a house, but you guys obviously can all make your own personal life decisions. But why I think a lot of people these days are so crazy about buying a house is that what Oswald Damodaran does is he puts asset returns for these asset classes over 100 years, or since like 1900, over 100 years. But then what you'll find out is that the empirical properties of these asset classes are very different in the last 30. And then it's kind of curious why. There's no right answer, but I'm curious what range of answers you guys come up with. But in particular, obviously, as I think the way I'm discussing it implies, housing returns have been kind of bonkers the last 30 years. But it's actually very much so unlike the 100 years before it. So anyway, hopefully you guys find that fun. I have one or two conceptual questions. And then this year, also another factor benchmarking one. But this one, it's not as like newsworthy. But this one's kind of interesting because there's this explosion in the asset management industry called smart beta ETFs. And what smart beta ETFs are is that basically they claim to provide you guys exposure to the academic risk factors that people study at an ETF price. So the thing about mutual funds is that they're super expensive, extremely expensive. So on average, like for instance, I don't know what it is in Hong Kong, but like there's in the US, mutual funds are like on the average of like 1% NAV. So in every year, basically they'll take 1% of your money. Hopefully they return that back to you in outperformance. ETFs are on the order of 20 basis points for potentially the same thing. And so these smart beta ETFs promise you the quant strategies, but at like ETF prices. And so basically what I have here is a bunch of ETFs, which I may or may not have in my own portfolio, which is also how I got this idea. But basically, essentially just using the factor benchmarking regressions to infer first what the assets are, how to interpret the regression. So I have some conceptual questions about that. And then I thought this was really interesting. One of the things that we're going to talk about today and the most popular trading strategy in the world is this thing called momentum investing. And there are a couple of these major ETFs put out by various major companies that claim to be momentum investing ETFs, and the empirical properties of them relative to various benchmarks, such as the momentum benchmark portfolio that we're going to study in class, is actually very different. And so you'll see some pretty interesting stuff. And then I'm going to ask you to just like think through it. So why is it that basically these momentum ETFs are so weird? When you regress them against momentum itself, the result will surprise you. Just I'll put it that way. And then just reasoning through why that is, and basically whether or not there are better ways of implementing these trades. And so like I think when you're in finance and you actually trade, I think a lot of the thing is really like you want to put on a trade, but it's also like thinking about what exactly you're picking up and how to put on that trade very cleanly. And I think this is like at least a conceptually interesting problem. And when I ran it through GPT, I had no idea how to do it. So that's at least that. So kidding, but and then I have some interesting conceptual questions, at least interesting to me. So yeah, a little bit, hopefully it gets you to think critically about what these regressions really mean, because this is the most important skill in portfolio management. And also made it due February 21st, which I believe is after we come back from Chinese New Year. So people cannot accuse me of making them work during Chinese New Year like they did last year. So, but please get started faster. And if Chinese New Year is about fun, I promise you the homework's fun. So, this is some stuff about regressions. I'll talk about this stuff later when we get to it. Basically, in finance, there's a lot of time correlation that you have to worry about that they typically assume away. But probably a little too technical right now. Okay, so hopefully it's clear what we want. We want to be able to have evaluate strategies, and we want to know whether they're good strategies to invest in or bad strategies, at least according to a simple rudimentary framework. Now, of course, in real life, there's going to be additional considerations like what is my investment mandate? Do I think the past will predict the future? But in as much as we can at least statistically assess the empirical behavior of different assets, we would hope that we can at least identify what's good alpha, what's good beta. Now, then the question is, how do we get to the point where we have QMJ, right? Or something like that. And so we're going to start with understanding the techniques for coding up a strategy. And then as we master this the next class or two, then it's rinse and repeat. Everything in pretty much every in quant finance for like 30 years has been some variation of these simple tasks that we're going to show you this class and next. So how do we get to the point where we have something like QMJ to evaluate? I'm going to show you it's quite rinse and repeat. Okay, so the first thing is, what do I mean by a trading strategy? We talked about this last class. I think most people, when they think about what is a trading strategy, think of the first type, which I'll call a time series trading strategy. And I think most people actually, when they think about that, when we talk about quant finance, are actually doing what's called the cross-sectional trading strategy, which they're not exactly different from each other, but they do have slightly different properties. So let's take I don't know, Alibaba. Okay, let's say I think Alibaba is going to go to the moon this year. Okay, I don't know why. Maybe because Jack Ma is our colleague now at HKU, and so therefore I have positive feelings about him and therefore his company. So let's say that for whatever reason, I think Alibaba is going to go to the moon. Okay, so what a time series trading strategy is this idea that I'm going to predict whether a stock, asset, security is going to go up or down. Now, I might feel great things about Alibaba and my new colleague, Hong Kong U professor Jack Ma, who actually, I don't know if he's actually ever stepped foot in the KK Leung building, but anyway, I have some positive feelings. Now, what's the problem with that? Well, so I think personally this year, I have reasons to believe the Chinese market may or may not go up this year, but last year was obviously a stinker for the Chinese market. Let's say I think Alibaba is going to outperform the market in China by 5%. Now, what's the problem with the time series trading strategy? Actually, even if it outperforms by 5%, how much did the Chinese market fall last year? Anyone know? No? I could just check my stock portfolio, but let's call it 10%. Okay, let's call it 10%. Okay. So if I thought that Alibaba was going to win and beat the market by 5%, then my portfolio actually fell 5%, right? Whereas if the market went up 10%, then sure, Alibaba went up 15%. But obviously the problem that I'm getting at is you're predicting whether a stock will go up or down, then essentially that's quite difficult to do because it's going to be contaminated by a bunch of other stuff. So in particular, if I think a stock's going to go up, the overall stock market may go up or down, right? That's obviously the problem I'm getting at. And if you think about the problem of, like, for example, an individual stock, there are like a bunch of different individual stocks that people don't pay attention to. So I think Alibaba, people pay attention to it, but like if you find like a tiny micro cap in Hong Kong, it's very likely that micro cap in Hong Kong's not so efficiently priced. It might be overvalued, might be undervalued, or whatever. It's less likely Alibaba's underpriced because so many people trade it and cover it in the stock market. It's very unlikely that overall, as a whole market, the overall market index is underpriced or overpriced, right? So if you think about it, it's much harder to predict the aggregate stock market and generally whether a particular stock, which is exposed to the market, is going to go up or down. It's probably much easier to predict whether or not Alibaba is going to relatively outperform other stocks in some benchmark. So if in the case where I think Alibaba is going to outperform by 5%, then what I could do is take a relative value trade, short the Chinese index, go long Alibaba, and then that's basically what people call a relative value or cross-sectional trading strategy, right? And so most of what we know is about the cross-section because it's really hard to predict the overall market. It's relatively easy to predict the relative performance of stocks. So just to visualize that in ugly Excel, basically what a cross-sectional trading strategy is the first one. Basically, you're thinking about a single slice of time and saying, at this point in time, do I think certain stocks have higher expected returns than others? Whereas a time series trading strategy takes a single J. So in this one, we're examining all stocks indexed by J at this particular point in time. So it's a cross section of time. Whereas a time series says, let's track one single J over time. okay? And if we think that it's difficult to predict the overall direction of the market, and we think the overall direction of the market explains 90% of the movement in any given stock in an equity market, which I think is roughly true. I think if you literally took every stock and regressed it against the market on a monthly basis, the R-squared would be like 90-something%. Then you're really taking a bet on the overall direction of the market. If we can't predict the overall direction of the market very well, then it's going to be hard to do this. But in general, it's going to be relatively easy because I have like 4,000 US stocks, 3,000 Chinese A shares, 2,500 Hong Kong H shares. I'm going to find something that's relatively underpriced or overpriced, right? And so you have a lot more options, and we just have a lot more knowledge there. So we're going to do the first one, not the second one. We're going to spend some time talking about the second one in like one class, and but I don't think it, at least in the open source, we have very good. I'm sure like there are people who can read a crystal ball and figure out what happens in the market next year. It's just that we don't have very good like open source quant Python notebooks that do that, or like papers that do that. And typically the horizon over which open source papers think about it is like over a quarter, and like not at some horizon that maybe you care about. Okay, so we're going to do cross-sectional backtesting, a cross-sectional strategy backtesting. This form of backtesting is very similar whether you're talking about equities or not, right? So if you're doing crypto or currencies or bonds or options or whatever, the fundamental idea, a framework of backtesting and doing cross-sectional analysis is pretty much the same, okay? So the way, basically, if you learn this particular structure, you can pretty much read like any paper out there. Okay, so the way I like to break this down is I like to break this down into two steps. There's a distinction between and this is a distinction I'm drawing. I'm not sure other people think of it in these terms, but the way I think about it is you have a strategy and then a trade, and then a way of trading that strategy, right? So in particular, like suppose what I mean by this is there's a difference between a signal and the way you implement it, the execution. So the first step I want to go after is what do I mean by a signal, and then second, what do I mean by trading, and then basically and then explain the logic behind the way people typically backtest things. And the distinction is basically that what people, when they're thinking about backtesting, are trying to evaluate is whether or not this idea, this signal is good. And then how you actually trade it is less of a concern because different managers will trade the same idea in different ways. Okay, so the first thing I want to do is talk about what is a signal, and then I want to talk about how we trade it. Okay. Okay, so wait, we started at 6:30. Okay, let's take a break in maybe 15 minutes, but let's go for now. Okay, so basically, basically when we talk about cross-sectional trading, the way that most people express backtests is through what's called portfolio sorting. Now, what is portfolio sorting and what is a signal? A signal is just a number, it's a score, and the score has the following property. If you score lower, on average, the expected return is lower. If you score higher, on average, the expected return is higher. So what does this mean? In the case of QMJ, quality minus junk, it means that the stocks that are high on the score are high quality stocks. Therefore, they earn high returns. The stocks that are low on the score are quality minus junk, junky stocks. We expect lower returns. So what portfolio sorting does is it says, okay, we can rank 2,000 stocks or whatever. Let's put them into into a number of buckets. Why is it that we would put them into buckets? It's because, first of all, we're looking for patterns, right? Second of all, even if I found one stock with the highest quality, I don't really know if this signal is going to explain all the movements in that stock. So maybe what I want to do is invest in a basket of stocks, because if I take any one stock, a bunch of shit can happen. Sorry, excuse my French, but the idea is I'm going to take a portfolio of stocks, and then what I'm going to do is I'm going to expect that the stocks with the highest, like 10%, 5%, highest 100, will generally speaking outperform the stocks in the lowest spin. And so the idea is I have a score. I expect the score to rank stocks in terms of expected return. And then what I'm going to do is basically just rank the stocks and put them into different buckets, different hypothetical portfolios. In practice, you probably don't want to buy just one stock anyway. And so in some sense, you're always going to buy a portfolio. And the statement that I'm making here is that I expect the long to outperform the short portfolio, but also that maybe the long here outperforms the things below it. So specifically, I would expect on average Q10 to have a higher score than Q9. So maybe the stocks in Q10 should outperform the stocks in Q9. The stocks in Q9 should outperform the stocks in Q8. The stocks in Q8 should outperform the stocks in Q7, so on and so forth, right? It need not always be true, but I expect that to be true on average, right? And so that's basically the idea of a signal. Now, and so basically, whenever you read backtests, they oftentimes have different buckets. Now, the question is, why did I pick 10 buckets? It's because the number 10 is easy. Sometimes I've seen 20. In currencies, there's like 100 there's like 200 currencies. I actually don't know how many, maybe like 100 something currencies. And a lot of them you can't freely trade. So maybe when you do currency trading, you're really talking about 4 or 5 portfolios, maybe 3 portfolios. It really depends on how large your universe is, but the idea is you want to bucket from low to high, okay? And how you actually trade is a little bit different. So what do I mean by a signal? And then what I mean, how do you actually trade? So an example of a signal might be, let's say social media sentiment. This, I think, would not actually work. It's actually, I think, the opposite in data, but basically the idea is, suppose you had Chinese social media, and the idea is that you have this wisdom of crowds. So what you want to do is collect all the sentiment out there on different what do you call them? Posts, tweets. Anyway, so what you want to do is collect all the stocks mentioned, and then maybe what you do is you count the number of smiley emojis and then all number of negative emojis, and you form a sentiment score. So maybe what you do is you calculate the ratio of smiley emojis to total emojis or whatever, and you hope it's more smiley means higher sentiment, and these are the stocks you should buy, right? And the guys in Q1 either have a bunch of sad faces or whatever. And so the idea is you basically score stocks at a particular point in time, let's say the month of June. And then what you do is you say, well, these guys should outperform these guys, and then the guys at the bottom should definitely underperform. Now, and the reason why people backtest this way is because the goal of backtesting this way is just to say, let's come up with a common convention we can all agree on, so that at least when I go from, if it's Weibo sentiment versus momentum versus Twitter sentiment versus something else, let's keep the way we present the data to be very similar across papers. So typically, there's basically like 2,000, 3,000 of these papers that look at different signals that we know about, and there's probably a lot more that people keep hidden. The idea is what people are interested in is actually understanding whether a signal adds value. How you actually implement the trade, who knows? So, but what people want to know is that it's the way that the signal that you constructed, not the way you trade it, which adds value, because every person who trades can trade it differently. So what people typically do is they have this idea that they have a signal, like in this case, Weibo sentiment or whatever, the number of posts on social media may be a different one. It's not just the emojis sentiments, the number of posts or whatever. And the idea is, as we do these different presentations of different trading signals, we want to make sure that the implementation of that trading signal is not what's driving your backtest. We want to make sure that it's the signal that you're considering that drives the backtest. In practice, would you actually go long this leg, short that leg? And how exactly would you implement the trade? It's unclear. But people want to know that the signal is it's apples to apples across papers. You might in practice go long only. You might in practice go short only. You might in practice go long short. The top 10%. In practice, you might just go long the top 5%, along the top 50 stocks. In practice, you might send these recommendations to a manager, and then the manager decides what to do. right? And so in general, what people are doing is they're not so worried about how you actually implement it. Every person has a different investment process. But for the purpose of backtesting, we keep the way that we hypothetically trade very simple. And then what we do is we then vary the signal that we put into it. And then the same thing goes with, like, how we cut this thing. The same thing goes with how often we hypothetically trade. And so sometimes when you read papers, you might say, oh, we're going to see hypothetically what happens to a signal if you trade every month. And then you might ask yourself, trade every month? Are you really going to work as a trader just once a month? You trade every day, or every week. Seems stupid. But the idea is, if it works, you just want to be able to compare across signals. I mean, of course, you can do your back test at a weekly frequency or daily frequency, but the idea is you want to keep it as simple as possible, because how you actually implement it in your portfolio will be different. We just want to make sure that across papers, we're doing apples to apples. So there's a sort of generic, somewhat arbitrary philosophy for how people backtest. The basic baseline is you have a signal and you have really stupid trading rules. Okay. And so there's basically a lot of different, there were a lot of different conventions early on. I think in the last maybe 15 years, people have pretty much settled on the same conventions across all papers. So the point of, I think, this class and next class is to say, what are the conventions? Why do they exist? And then next class, we talk about how do we actually code up things in that way. Okay, this is probably a good time to take a break. So why don't we take a break until 7:40? And then when we come back, I'll go through this whole list and explain exactly what the details mean. All right, let's get going. I'm pretty confident we can get out of here pretty early today. So, all right. So, just a little recap. Our goal is to basically say, hypothetically, how do investors, if I'm considering like whether or not there's a signal I should put in my portfolio, how I might trade it might be different from investor to investor. But the convention in the literature is to say different people will trade differently. So why don't we just hypothetically, when we're back testing a trading strategy, let's shut down the trading convention and let's just focus on making the trading very simple. And therefore, the only thing that varies from test to test, if it's standardized, is the signal. So what people do is then they cut things into portfolios. They decide hypothetically that you would trade a certain way. Specifically, you would buy the top 10% or top bucket, short the bottom bucket. And then they have their very standardized trading rules. And then what we do is once we have a standardized trading rule, for instance, QMJ is on a monthly basis, you buy high quality stocks, short junky stocks. You then evaluate the performance, kind of like what we did in the first class, plus some extra stuff. So what exactly are those other missing details? The missing details are how frequently you trade, how you split capital, your potential allocation, and then what is your filterable stock universe? How often you trade, typically it depends on what type of signal you're trying to backtest, but it depends on, but in general, we try to make it a certain way. The long story short is we try, when we write papers, to write to our audience. And for academic audiences, they were considering large institutional asset managers. One reason is because when you're testing efficient markets, you kind of don't care if meme stocks are stocks that are mispriced. What you're worried about is you're kind of worried that like Apple or like the major stocks are mispriced, the blue chip stocks. It'd be fine if like a small $50 million company was mispriced. It'd be harder, it'd be less, the market would certainly be more inefficient if the mega stocks, the mega caps were mispriced. So typically what people do is they focus on the large stocks. And when you focus on the larger stocks or the liquid stocks, you're thinking about potentially what a large manager like BlackRock, State Street, Vanguard, Value Partners, whatever, these large companies would trade. And when you rebalance very large portfolios for companies like BlackRock, it takes time. So the concept of most backtests by default is to cater to the large institutional asset managers, mutual fund advisors, AQR, all these names, not just multi-billion, but oftentimes maybe even 100 or 200 billion. And it takes those guys a while to move money. So we trade at somewhat of a slower frequency, monthly or quarterly, sometimes in some backtests annually, at least in academic literature. But in practice, depending on the strategy, depending on who you are as an investor, you could trade daily, intraday, whatever you want. But what you'll often read is monthly. Typically, people will show a couple of different versions of dollar allocations. The two most common are equal weighted and value weighted. What is equal weighted? Equal weighted means that if you have Apple and a meme stock, the meme stock has the same portfolio allocation as Apple, even though Apple is still the largest company in the world. But the idea is a meme stock, a small stock and a large stock have equal weight. Value weighted means that it's proportional to market cap. So equal weighted has the benefit that it's simple, right? And generally speaking, smaller stocks are probably more inefficiently priced. So it's often the case that if you have some sort of strategy, it tends to work better on equal weighted basis. We'll revisit that concept. Value weighted typically tends to favor liquidity because you're going to have larger stocks as part of your portfolio. Typically, the returns are smaller because we tend to think that Apple and NVIDIA and all these companies are probably more efficiently priced than a tiny stock you've never heard of. Now, I'm not sure these days NVIDIA is properly priced, but you guys get the idea. And so the idea is basically people show variations of this. This favors a small trader this favors a big trader. And if they're very different, it gives you some idea where returns might be coming from. And then people have filters for the stock universe. And in particular, what people do is they filter for, and again, this is not necessarily what I think you should do, but they filter out stocks that they think are too illiquid for a company like BlackRock to ever possibly trade. And I'll explain what those filters are. Now, if you're a small trader, maybe you don't want to do this, okay? Maybe you actually want to do the opposite. You want to, sort of deal in a space that other people aren't dealing with. But again, that's really like dependent on you. I'm just trying to interpret what you're going to read potentially. Now, I think these rules don't just apply to BlackRock. I think probably to some extent, a lot of the same rules apply to hedge funds of like $1 billion or $2 billion in size. I'll walk through some rule of the thumb math, and you'll sort of understand where the math sort of comes from for some of the specific implementations of these filters. But again, but typically we cater to, in these types of literature, the super large asset managers who do implement factor strategies. Okay, so first of all, again, we're just sorting stocks. We're scoring stocks in this way. We pick the top 10%, bottom 10% as an extreme, and you can cut more finely. How you implement in practice is you might buy a finer set, like 100 stocks or 50 stocks. The only thing I would probably say is that if you're examining a quant trading strategy, you probably never want to buy too few. There's a rule of thumb, like if after at least 20 stocks or 30 stocks, you're pretty well diversified. But suppose that I had one stock who on Twitter actually turns out to be awesome, right? Or Weibo or whatever. And this stock, let's say, has the strongest social media score that you've ever read. Would I want to trade that, even though relative to the other things in the top 10%, the score is much higher? And the reason is you don't want to do that is because basically, even if you have the best machine learning or whatever, best alternative data, in general, quantitative signals are very noisy. So what that means is it's machine learning models in general. You guys probably take machine learning now. In general, a good R squared is probably like on the order of like 95% or something, right? Maybe even higher. So if you were like, have you guys ever watched the show Silicon Valley, where the guy, you guys never seen Silicon Valley? Okay, so there's this Hong Kong, this guy who grew up in Hong Kong, who plays this like Silicon Valley guy, and basically he has this app that is called Seafood, like do seafood, and then basically it's a Cantonese joke if you think about what seafood sounds like, but basically the app, what it does is it identifies whether or not something is a hot dog or not, and eventually it's supposed to become like an app that can tell you what type of food is in the picture. Anyway, the point is, for those types of models, we typically get R squareds of like 99%. For asset returns, we typically get machine learning models at the monthly frequency. I'm guessing the best machine learning models are on the order of like 30, 40%. Like it's very noisy. Asset returns are extremely noisy. So no matter what signal you have, you cannot really depend on the signal for any one stock. Okay, in machine learning, what you can, if you have an industrial grade machine learning model that identifies food in a picture, you can get like 99% R squared. For asset returns on any individual stock, I would guess that, especially at high frequency, you cannot predict the price or the return of a stock with higher than 20, 30%, if ever. So if you, for instance, you use a quant trading signal, let's say it's social media sentiment, Apple, the number of tweets, well, you might find out that maybe Apple has a really high social media score, but then you find out that the tweets are by Donald Trump, right? And there's actually probably some evidence that if Donald Trump tweets about a stock, the stock actually falls. I think that's actually true. I think someone actually did compute that. And so what I'm saying is, for any given situation where you have a quantitative signal, it might be true on average, but the value of that signal, given how noisy returns are, is very low. So because noise is very high, the noise is very high. So because noise is very high, you typically want to take a portfolio you cannot, there's a limit to how thinly you can dice portfolios because you need a certain number of stocks before the idiosyncrasies that contaminate any individual stock really go away. So basically, I guess the point I'm trying to make is how you actually trade when you backtest a quantitative signal. Ideally, 10%, it gets even stronger the top 5%, 1%. But if you've cut it too finely, because of the noise in asset returns, the idiosyncratic noise in any individual stock starts to dominate. So you do need like at least a minimum if you're going to trust these quantitative signals. Now, if you're human, maybe you can pick the top 3 or 4 or whatever, and then you can sort of depend on your human intuition to actually read the tweets or whatever, or to interpret, interpret the news on top of the signal. But you can't just blindly trust signal. And if you do, you certainly can't go to the extreme and pick like the top 5, right? Because the top 5 or whatever, there's so much idiosyncratic noise in any individual stock. So that's sort of the point that I'm making. And in general, returns, especially at higher frequencies, have such low R squared for any machine learning model or any signal that you cannot really, you can't really trust a signal enough that you wouldn't be better off with some sort of basket of stocks, is sort of the idea. Okay. So in principle, basically, there's another reason, we're going to backtest hypothetical portfolios. Probably portfolios of some kind are better than not pursuing portfolios. But how you actually implement it in your practice is actually quite different also. So for example, one thing that you might actually find in practice is that you have an ensemble of other signals. You're not just thinking about trading one signal in isolation. So I'll give you an example. Suppose that you were in one strategy long Apple, in another strategy you were short Apple by the same amount. Would the strategy be in half your money you buy Apple and half your money you short Apple? The answer is obviously no. You'd have some sort of internal trade optimizer that would say, oh, guess what? Let's just not trade Apple because if I just short it and then buy long, then on average on zero, right? And so I'm just paying extra fees for no reason. So you might have other trading signals. Obviously, like I said before, you might buy the top 100 or top 50, hopefully not the top 1 or 2, but the top 100 maybe. And then you might have other rules like stop losses, limit orders, whatever. In practice, whatever you do is very different. But again, this is just, how we just back test. Okay, and then basically we're going to talk about a bunch of literature that essentially all follows the same way. So, we're going to talk about the size effect, the value effect, momentum effect. Today we'll talk about the momentum effect. There's this new phenomenon called gross profitability, which works really well. When I tell you how it works, the intuition behind why it works is you're going to either think it's really dumb that it's so simple, or it's like, oh my God, it's so smart. How do we never discover this before last 10 years? This thing called risk parity or beta arbitrage. And that is, it's kind of this interesting observation that the CAPM really doesn't hold, but in a really interesting way. Quality minus junk. We'll also talk about a bunch of these other strategies. They all use the same portfolio approach in backtesting. And so this is pretty much 95% of academic literature is and industry literature is about, basically hypothetical portfolios that you form. Okay, so basically it's a hypothetical long short where you buy long on some signal, short on some level. How you actually implement it, you might go long only, you might have other trades, you might not buy the top 10%, whatever. But the idea is all of them pretend that you do this very simple trading rule. I guess a couple of caveats I want to make about this are in practice is a little bit different than how it's discussed in some of these papers. And so one thing I want to say is like, what are the mechanics of short selling? Because if you guys have ever taken, so if your background is from trading, you would actually already be thinking this way. But many of you guys have probably thought of finance from a textbook. And from a textbook, they, especially in like some of the older mathematical finance stuff, there's stuff like delta hedging. It's like you can basically delta hedge your portfolio for free and all this stuff. Basically, the reality of real financial markets is that stuff costs a lot of money. So when we form a long short portfolio, what a lot of times people talk about is they talk about essentially they assume a world where there's no transaction costs and that putting on a long short portfolio is essentially free. So what people talk about sometimes, for instance, in finance books, is they talk about this idea of a long short portfolio or some sort of zero cost portfolio. So self-financing portfolio. So what is a zero cost portfolio? It says, I go to someone and I say, hey, I think Facebook's going to outperform Snapchat. Can I borrow your entire Snapchat 1,000 shares, sell it to you, give it back to you in a month? I promise you, I will return you your Snapchat shares. Don't worry about it. And then he does this to me for free. I sell a Snapchat shares. I go buy Facebook, and then I make my profit that way. And then I sell Facebook. I return it back to him. That's what a zero cost portfolio is. I'll have an example here. In practice, it doesn't work like that. There's a lot of different problems. Like there's obviously transaction costs to the trading. There's also borrowing costs. If someone comes to me and says, can I borrow all of the Snapchat shares you have? I'd say, well, I guess there's some chance that you won't give them back to me. So can I have some money? So there's actually like a lot of different fees, like borrowing costs and margin. Oh, sorry, I started talking, but actually I have this exact example. Sorry. So a lot of textbooks, when they talk about, and a lot of academic papers actually refer to what's called the zero cost portfolio, but anyone who's ever traded something or tried to trade something knows that if you were to actually short something or if you're trying to short something and form a long short portfolio, there's actually a number of costs. So so the first cost is basically someone's going to charge me for borrowing those Snapchat shares, right? The second thing is if I borrow borrow shares, probably what I'm going to have to do is put up what's called margin, because in addition to the fact that I have to pay a borrowing fee, there's some chance that if Facebook falls, so I expect Facebook to go up relative to Snapchat. If Snapchat rises and Facebook falls, I'm actually going to potentially not be able to actually return the shares because the value of my Facebook position has fallen. And then the value of the Snapchat position has risen. So my liabilities have risen, my assets have fallen, and I'm screwed. So a lot of times for investors, if you actually form a long short trade, for example, you have to put up margin, right? And the margin, if you're just a normal retail investor who wants to go long short, might be like 50%. So the way that would work is if you do the math out, if you want to borrow, I think these numbers were basically matching Snapchat's price at the time. If I want to borrow $11 million of Snapchat, in addition to the borrowing fee, I'd have to put up 50% margin. That's sort of standard Reg T margin. For any of those who sort of are institutional traders or just like a retail trader who's filled out enough forms, you can get higher levels of margin. Bill Hwang famously, had, I think at some point he had like, I think it was like 20-1 margin. The Korean guy who blew up. Do you guys know who I'm talking about? Bill Hwang, like blew up a couple years ago, like, and then UBS was like really like, but essentially, I think right. So I think the highest you can probably get without some sort of like, you can probably get 4x margin as like a retail. And I don't know about Hong Kong, but I think in the US, if I wanted to get a higher margin, the highest I could probably get is 4x. You might like S&P futures or whatever, the margin's like 20 times. But anyway, the idea is there are limits to how much you can actually borrow. I think the highest level you can borrow is like 4 times. Typically, and then the margin also costs you some money as well. I don't know. Actually, I don't trade myself on margin, so I don't know what the prices are. But the thing I read online is probably it's like 5 or 6%. And then short selling costs money. Short selling fees are actually pretty small. Annualized, it's less than 1%. But the basic idea is just that if you were to form a long short portfolio, there's like a certain set of costs with that. And then there's also costs associated with actually trading, which we'll go over in a second. Okay. So we formed a long short portfolio. In the long leg and short leg, we have to decide in the long portfolio, how do we allocate our money? And then in the short portfolio, how do we allocate our money? So again, we basically do equal weighting or market cap weighting. One thing that I think actually would be good, and in some papers they do this, is 1 over signal or 1 over volatility weighting. 1 over volatility weighting is basically the idea that, sometimes people call this risk parity. If you have stocks and bonds, let's say 50-50, effectively the allocation is more stocks than bonds because stocks are a lot more volatile. And so 1 over volatility weighting is, I mean, I don't know if it's to be 1, but like volatility, sort of inverse volatility weighting is just the idea that everything has equal volatility, so bonds have equal contributions. So people call that risk parity. So what they do is they basically buy stocks, but then they borrow money and lever up the bond portfolio so that the bond portfolio volatility is equal to the stock volatility. That's what people call betting against beta risk parity. It worked really well when interest rates are low, and then I guess people kind of got screwed the last few years. But anyway, the idea is people do that. And then price weighting, don't ever do this. But basically what this would mean, and this is the reason why I mention this is because this is traditionally how price indices like the Dow Jones Industrial Average work. But basically what that means is if you have a share that's $5 and a share that's $10, you just buy 1 share each. That's really bad because you can have stock splits, or you can have a high market cap stock with a low share price, like Apple, or you can have the reverse, like a small cap stock with a high share price. And then finally, liquidity filter. So the idea is there's 2 elements to this. What are your actual transaction costs? And the other element to this is basically what is your investable universe? So the so the basic short answer is we don't know what transaction costs actually are. So the reason why we don't know transaction costs actually are is because the only thing we see in backtests are basically we see the prices that the market makes available. So if you wanted to figure out what the price of a stock was in 1920, I can pretty much where they get this from is there's like 1 price per day. That's like the closing price of the stock in the newspaper. So why that makes it so throughout the day, you guys know the prices fluctuate. And then hypothetically, even if prices didn't fluctuate, if I put on a really large trade on a given day, we don't know if there would have been someone else to trade with me. So we don't know what transaction costs really are. We don't actually know sometimes if a trade's even feasible. So how people try to account for this is they do 2 things. One is they basically assume away an investable universe where the liquidity problems are likely to be less severe. And some of these rules will sound really strange. I'll explain what they are, and then I'm gonna tell you like which ones are stupid and which ones probably are still relevant. And by stupid, I mean they're probably not dumb, but like today no longer relevant, I should say. And the other thing that people do is they say, even if, so I'm gonna look in this universe of what I think are relatively liquid stocks, and then I'm gonna assume a transaction cost on top of that. And so, it's pretty, and the short answer is we don't actually know. So there's this person who works at I shouldn't say which fund, but like one of the major funds. She went from academia into industry. She said the hardest thing for her when she actually transitioned was she thought she understood how to estimate liquidity and transaction costs, but it's the hardest thing that she didn't have to anticipate. So this is actually the hardest part. Like people just don't know. It just kind of depends on how, various market conditions, the asset you're trading, things of that nature, your trading strategy. But let's just try anyway. Okay. So typically in a back test, and I'll make a distinction between academic back tests and industry back tests. Typically in a back test, which I think this is both true for industry and as well as academic back tests. This will sound kind of weird, but they have what's called the price filter. Okay, a price filter says that I'm going to look at share prices above a certain level. So I don't know what it is in Hong Kong. Maybe you guys can tell me. But the reason why a price filter exists is that for much of history, there was what's called a minimum tick. So what a minimum tick means is that suppose the price of a stock is $420, 420, Elon Musk's favorite price. And I wanted to quote a bid-ask spread. A minimum tick says that bid-ask spread has to be a minimum size. So it used to be 25 cents. So that means that if I think the price is Elon Musk's favorite 420, then it has to be 420.25, 4.0 plus 12.5 cents 420 minus 12 in essence. That's a 25-cent minimum tick. I think there's a minimum tick in Hong Kong, right? Because when I try to buy BYD, for the price that I get is like 10-cent difference. Does anyone know actually in Hong Kong, is there a minimum tick? There is, right? Yeah, so I think it's a 10 cents. Do you know? 1 cent? Huh. Then maybe I'm like trying to buy BYD during lunch hour when like there's no one to trade it. Or maybe BYD is a liquid. I don't know. Anyway, the point is that for a lot of markets, there's what's called the minimum tick. And the idea of a minimum tick is just if you have a minimum spread, that means if you're a market maker making the market and you buy one, someone buys a stock from you and then you sell a stock. Sorry, if you buy a stock off someone who wants to sell and then flip it, you make at least 25 cents. So that makes it attractive to be a market maker. That's why we used to have it. They got rid of the minimum. So in the data, I divided the average bid-ask spread in CRISP, the data set we're going to use by $5. What this is the minimum tick divided by $5 over time. So people impose a $5 price filter because 25 cents over $5 is roughly is when you do a round trip cost is 2.5%, and then this falls in the 80s and then falls in the 90s, and then basically as we get into electronic trading, you can automate market making. So basically, it becomes easy for people to provide liquidity. Long story short is that over time this has fallen, but historically, this is why this idea of a price filter exists. But there is a minimum tick in a lot of different markets. And also they brought back, even in the US, minimum ticks in recent years for small stocks, because what they realized is that there's no liquidity on small stocks. And if you want to provide liquidity, it's good to have like this bid-ask spread because the liquidity provider earns that bid-ask spread. So long story short, there's this really arbitrary, somewhat arbitrary thing that you'll see in both industry papers and academic papers around minimum share prices. So in more recently, I've seen some industry, like some hedge funds put out like white papers where their minimum price rule is they only consider things with at least like $3. So it's like a little bit better today, but this actually does bind. And then it basically just depends on if you're in a market with a minimum tick. In a lot of older papers, what they do is they consider only the New York Stock Exchange. And the reason for that is because in the US, there used to be like a bajillion exchanges. And basically, New York is essentially where the financial center of the United States was. So they do everything based on the New York Stock Exchange, and they pretty much ignore everything else. I think that one, I think we can all agree is like reasonable. Nowadays, NASDAQ is actually bigger than New York Stock Exchange. So NASDAQ's where like Apple and all those companies are. So nowadays, New York Stock Exchange doesn't really matter, but I mean, they both matter, but there's a blurred distinction. And then what people often used to do is, and this depends on the country you're in, but they exclude utility stocks because utility stocks are government owned. And it's kind of like, and then financial stocks, the main reason is because financials, a lot of the strategies are about financial ratios. So the meaning of assets is very different for a bank than it is for like a manufacturing firm. So it's, that people remove that. This one I think is, you can probably ignore the financials thing unless you're doing a financials ratio thing, but people by default exclude utility and financials. Is kind of weird. So depending on the paper that you read, you'll see this still. So what practitioners typically do nowadays is they probably do the price rule. And then I've seen, and this is probably the most common, they include a market cap filter and a dollar volume filter, or a dollar volume filter. So $100 million is pretty much entry level for a lot of these like institutional traders and hedge funds, and then about $1 million of volume per day. And on top of that, they'll assume something like 5 to 15 basis points transaction costs. Whereas I think a lot of academic papers will basically never talk about the assumed transaction cost. But it's lurking in the background. They just don't take a stance on it. The reason why it's $100 million is you can think of it the following way. So like, I think if you're like one of the elite hedge funds, you probably have, let's say, $10 billion at least. And then let's say you have however many portfolio managers, like 10 major ones. Within that, there's like individual traders. Let's say the average trader at one of these major companies has $50 million. So then, first of all, They're probably trading multiple stocks, but they can't trade too many, right? So, but if you basically think about a $50 million portfolio, you can imagine that if you don't have at least like $1 million of volume, then pretty quickly, if you try to trade $1 million on one day, then you just cannot possibly hide your volume within, the average daily volume. You just like do the math, like how much an individual trader at one of these banks or hedge funds probably has, and then how much they're actually trading. If there's not at least like $1 million of volume, then you try to trade $1 million, you basically consume all the volume, right? Like you would push the price for sure. So oftentimes, if people want to back test, they might have some filter like you need at least $1 million. Otherwise, you're not sure if the back test return is really going to be realistic. And then on top of that, they assume something like between 5 and 15 basis points. So like Deutsche Bank put out a white paper where they showed a P&L curve, and then they actually showed 5, 10, and 15 basis points as assumptions. And then $100 million just because if you buy $10 million of a company that's $20 million in market cap, you own half the company. That's like never going to happen, right? So like $100 million is like an arbitrary number, but 100 million US, sorry. And then it'll defer. Like you can, and I'm not sure that's necessarily a good idea for you to impose these numbers. But if you're thinking about like what would a hedge fund trade with like $10 billion or BlackRock, I think $100 million is probably even too small. But that's basically just like sort of the math. So this is typically what I'll see. For the purpose of this class, we'll do something, but just keep in mind that in practice when you're back testing, this is something that your back test will lie a little bit, but this is at least like what people do to sort of ballpark the right price. But in practice, the transaction costs come from, where do the 5 to 15 basis points come from? They come from the bid-ask spread, right? Which we've talked about. And then the bid-ask spread is typically just the top of the bid order book and the sell order book. So it's like 900 shares at a certain price, 1,000 shares at another price. And then basically, if you buy more than 900 shares, then you have 1,000 shares, for example, then you basically push the price because you have to get the next price on the order book, on the limit order book. And then that essentially means you'll push the price in principle. Yep. Okay. Yeah. So that's basically it. So let's just quickly recap. You form a hypothetical long-short portfolio. You ignore costs. In practice, you have to put up margin and borrow short. So that's probably a couple % per year. On top of that, you actually have to make the trades. How you make the trades is you either do them equal weighted or value weighted. And then you only look at certain stocks that you think are relatively liquid. Not saying you have to, because if you don't have that much money, then it doesn't really matter if you can't really move the price that much. And then typically what people assume is for a hedge fund of a certain size, about stocks with at least 100 million bucks, $1 million of volume per day. It's basically about 75 to 80% of the US equity market is liquid. And I'm not sure what percentage it is in Hong Kong, but I know there are a bunch of really tiny stocks in Hong Kong. And then you assume 5 to 15 basis point transaction costs per month, assuming you trade monthly. And that's pretty much, I think, what most people would assume as like a starting point. I do know though at DFA, when I was talking to someone who's like an academic consultant there, he said he used to spend all his time coming with alpha strategies. He spends all this time thinking about how to minimize transaction costs. So this problem never really goes away when you're super big. But I think this is probably the starting point for like an alpha quant, like that ballpark. But if you're super big, then I don't know. It's probably instead of 100 million, it's like a billion or something. I don't know. Okay, so basically, what you need to. So what I have here is a checklist. I think the checklist is a lot of word salad, but so let me get through it quickly. But I think it's easier to just show it, and then basically, long story short, we talked about alpha, and we talked about Sharpe ratio. So what basically you need to do, if you have a hypothetical trading strategy, the hypothetical trading strategy every month produces a long short return, or every week or whatever, produces a long short return. And then you can calculate the return, the Sharpe ratio, and the alpha from that. What's different about this and just what we did in the first class is there's a couple of extra tests, which I think by showing you, it'll make sense why we do them. But hypothetically, what we're doing is we're buying the top 10% and shorting the bottom 10%. What we didn't do is we didn't do anything about the stuff in the middle. And so what do we do with stuff in the middle that we throw away? We also do variations of the test, equal weighted, value weighted. And then, and so you'll sort of see as we go through it, why we do that sort of stuff. And then finally, we're going to do this complementary tool called an event study, which you haven't seen before, but it'll sort of make sense when I show you some examples. So what we're going to, so basically what you learn in the first class is already half the test you want to do. The hard part is getting to that point. But what we talked about last time was just the top 10% minus the bottom 10%. Is trading the top 10% even reasonable? I don't even know. But what we want to do is then, just check what happens elsewhere in the distribution. And then this idea of an event study. And so these are all statistical tests. Basically, the idea is these are statistical check marks. The harder part is this idea of why. So what do I mean by why? The basic idea of why is this idea that if you have any given backtest lie, right? That's the idea that sometimes the cynics say. The idea of backtest lying means that maybe you got lucky. Maybe you found something at this point in history. Maybe you happen to try one thing and that happened to work, but it's not clear that that would ever happen again. And maybe you were even data mining. I don't know. The idea of understanding the story behind a strategy is to understand whether or not the reason why the strategy earns you a certain type of return in your backtest is a fundamental thing that you can expect to happen in the future. So one of the things that people argue is that in any given backtest, you may or may not have gotten lucky. In any given machine learning model, you may have gotten lucky in your backtest, but whether or not it'll extrapolate into the future depends on whether or not you think the past will look like the future. And in order for you to understand whether the past will look like the future, you have to understand why exactly returns were earned during your backtest. What is the economic reasoning for your strategy to work? So a simple example of this would be for a company like Citadel, the high frequency arm. What they're doing is they're providing liquidity and they're basically doing arbitrage. So sometimes if you look at, for instance, ETFs, if you constructed the ETF's underlying assets, right, and you look at the price of the ETF, there's definitely a mispricing between them. And if you think that that's always going to exist, then your backtest will look great. Your actual performance will look great. But there are certain types of times in history where things change, right? So one of the things that has changed a lot over the last 30 years is interest rates, right? So maybe housing returns. Why are housing returns so ridiculous the last 30 years? Is because interest rates were low the last 30 years, right? And so maybe if it's easy to borrow money, then people can keep borrowing money and buying houses, right? And so that's an example of something where you might understand the economic story, and then it's an interest rate play. Now, I'm not sure that that's the reason why housing returns are so crazy. There's other stories like economic scarcity, things like that. So maybe it's that, people want to live in the city because the city is where all the good jobs are. And that's increasingly the case in the knowledge economy because we don't have to live on farms and factories anymore. There's all sorts of stories. And that could be why housing returns have been high. But depending on your story, that's going to tell you whether or not your backtest return is going to extrapolate into the future, right? So, whether you do machine learning or not, the sort of guard against data mining is the idea that there's an explanation for some of your results. Now, there are people who do machine learning that believe that the only way machine learning extrapolates is that you have economic reasoning behind like lots of the relationships. There are some people who don't give a fuck either way and say your model's so good, it can just keep learning the non-obvious structure of economics. And so there's some people who don't know finance that are just 100% on the model. And there's some people that believe in interpretability. So like, for instance, even the OpenAI guys, when they look at like GPT, They say we can't possibly, deploy an AGI without understanding what makes it tick. It's like sort of the same thing. There's this big debate about whether or not you need an machine learning model to be interpretable or a model to be interpretable. But the basic idea is you ideally would like to know why your strategy makes sense, and ideally corroborate some of the hypotheses behind your theory in order for you to determine whether or not you think it's a robust feature of financial markets or whether or not you just got lucky in your backtest. And actually, one of the things that we find is, and I'll explain, there's a big debate about why, but a lot of the stuff that you read that's backtested, literally the first 2 or 3 years after the paper gets published, the returns of that strategy drop. And so, there's a big debate as to why. And so that's basically like, now again, there are some people who say, I don't care why the story works. The model seems to work so well, who cares? But there are some people who argue, who even do the fanciest models that argue that you do need some sort of economic story or else this will never sort of extrapolate out of sample. And so there are people on both sides, but I think more people are on the side that you do need a story of some kind. Okay, so all of this might seem super abstract. So let's just talk through a strategy. And this strategy is basically the most robust strategy in the sense that if you look at any given asset class, there will be the first thing that I think you should try, and that most people will try, will be some variation of this concept called momentum, right? This is one of the oldest strategies in the world. And basically, the reason why momentum is particularly interesting is it's also a good strategy to teach first because it's so easy to actually show you in code. As we go through more strategies, some of them get a little bit more sophisticated, but momentum is probably the easiest. And the reason why momentum is particularly interesting is because the returns are very good in a back test. And it was also very historically important because it was probably the first strategy where people were like, wow, let's all start doing quant equity. Some people would say momentum is one of the reasons why in the 90s we had a lot of quant equity trading strategies. And it's also particularly interesting because of how dumb the strategy is. The strategy is just based on past returns predicting future returns. In like higher returns predicts in the past predicts higher returns in the future. If you believe in even the dumbest form of efficient markets, that should not happen. So the strongest form of efficient markets is, not even Jack Ma could insider trade the Alibaba stock. The semi-strong form is basically Jack Ma can insider trade, but not even someone who does alternative data can beat the markets. And then finally, the dumbest form is no technical trader should be able to beat the market. But momentum is not only really simple, it beats the market. Now you can make arguments as to why that is, but it's the first time people just felt the license to say markets are definitely not efficient if momentum were true. So historically, it's quite important. It's something attributed to 2 people. This guy named Clifford Asness, who's the CEO of AQR. He went to Goldman Sachs Asset Management first. He was at the University of Chicago, and he studied under Eugene Fama. I actually never read Asness's paper, but supposedly he was one of the contemporaneous founders. Within academia, among those who stayed and those who didn't sell out, there's this one guy, I don't know how to say his first name, so I'm not even try, but his last name is Jagadish. He's at Emory. And this last guy, the second guy, his name is Sheridan Titman, who, if you read the original paper, he actually, this is like one of the most important papers in the world. He was actually at one of the Hong Kong institutions, the lesser institution of Hong Kong UST. But he was back then a Hong Kong UST professor. No, I'm kidding. I love the Hong Kong UST guys. They're not the lesser institution. Don't tell them that. But anyway, I'm supposed to say that as a Hong Kong U guy. But he was actually originally a Hong Kong UST professor when he wrote this. So back in I think it was like late 80s, early 90s, Hong Kong UST was like actually one of the best finance departments in the world. Because I think Hong Kong UST, I think it's like a school that started in the 80s or something like that. Back then, they just started the business school, and then they recruited a bunch of guys from UCLA to run the department. So back then, actually, UCLA was also amazing. Still a very good place. And then Hong Kong UST was like the best department, like one of the best departments in the world. And so Sheridan Titman wrote this famous paper that basically some would say started the quant equity industry. And so of course, you guys, I've gushed about AQR. They manage $225 billion in assets. Some would say that they're kind of boring. They don't have that many alpha strategies. They're all sort of smart beta products, but they're historically quite important. Okay, so here's momentum. And I just want to sort of take this time to explain momentum. And then the reason why I want to explain momentum is I want to give you a context of what it is. And then I want to show you how it gets manifest in an academic paper. So after this, you can see how typically this is written in an academic paper so that when you guys do your final, which is to replicate a paper, you guys will sort of understand how to interpret everything. It's pretty simple, actually. Okay, so what is momentum? So explain what momentum is. Let's explain what momentum is. So momentum is the idea that past returns predict future returns. So how does that work? So this is a stylized version of momentum. There's different horizons over which people do momentum. Should it be this horizon for every asset class? Is it data mining? I don't know, but I have some opinions, but you might think this is a little arbitrary. So just my caveat. So, but this is basically the original finding. The original finding is as follows. There's every month, let's call this month time t. What is this month? This month is February 2024. Time t is the month. It's a little bit weird. I would have thought time t, like now, is the month in which I'm trading. The way that most people write it is not the time t is not the month you're trading. Time t is the month after you trade it. It's the first month of your portfolio return. So time t is the month of your portfolio return. That's how most people write it. I think that's counterintuitive, but I would think time t plus 1 is when you observe your portfolio, and time t is when you traded. But it's the other way. It's shifted. It's time t minus 1 is when you trade it. So the way momentum works is there's an estimate period, a trading month, and then a return month. The return month is time t. Time t is February 2024. The trading month, therefore, is January 2024. So in the month of January, what I'm doing is I'm looking at t minus 2 to t minus 12. That would be February 2023 to December 2023. Over the 11-month period, what I'm doing is I'm just calculating the cumulative return of every stock over this period. What that means is I just want to figure out over this period, did the stock go up or down? And my signal is how well did you do over this period? That's it. It's like the most simple thing. It's so mind-bogglingly dumb that it strikes me as odd that markets could be this way. But that's why it was so controversial. Is it possible that something so dumb works so well? And I'll show you how well. So why is it that at time t minus 1, it takes 1 month? You might say, well, I know the end of the month return as of December 31st, 2023. So why don't I start putting on this trade in January 2023? There's a couple of reasons. One is back then, in like the early 90s, people didn't have like laptops with like Python. The way people used to do back tests is they would have punch cards. You punch in like, you'd like literally punch holes in a sheet of paper, put it into a mainframe, you would get your results in like a couple of days. It's like very weird to think about. But basically, in practice, you actually probably couldn't have traded on January 1st, 2024, because you don't have the computing power to compute a simple 11-month rolling average, which nowadays is like a triviality in Python. But if you think about it, they were doing these back tests probably in like 1989, 1990, at which point most people didn't have a personal computer, right? And R didn't exist, Python didn't exist, all this stuff. So what we do is we skip 1 month, the month of January 2024, to allow people to basically compute all of these prices, to collect the data, so on and so forth. There also turns out to be a slight phenomenon where at the 1 month level, there's a little bit of mean reversion, meaning stuff that goes up actually comes down. So empirically, it works better if you do momentum just skipping a month anyway. But the main reason is because what people do is they assume that it took you a month to trade. And like when we get to accounting ratios, they typically assume that like it takes you 6 months to collect all the financial data for companies from the last December. it's like people sort of assume that it back then, we want to be conservative, that we don't have any look ahead bias, and it was actually implementable. So people skip a month basically. In practice, do you have to do that? No, not really, because nowadays everything's so quick. I mean, we can trade in high frequency now, but in 1989, we assumed that we could not have. So basically, again, what are we doing? We're trading in January 2024, time t minus one. We're just calculating the 11-month return, and we're sorting stocks based on that, forming our portfolios. We have 1 month to trade, and then we basically just, I don't know, relax or something. And then we observe what happens to our portfolio in the month of February 2024. Next month, in the month of February, what I'm doing is I'm trading to observe returns at the end of starting in March. The end of that period is January 2024. The start of that period is March 2023. And so it just keeps going on and on in time. Very simple. You just rank things based on the 11-month rolling return. You skip 1 month and then see what happens to the returns thereafter. Now, I'm going to show you basically, typically, now that you know what the strategy is, I wanted to basically explain to you, I want to show you how how it's represented in at least one of the papers. And the reason is because I want you guys to get used to the idea that reading industry or academic literature is actually very simple once you break it down. And then I want to break it down for you, show you how all the different tests look like. Then we'll call it a little bit early because we don't have enough time today to go through the code. Next class, we'll actually code it up. So this version, actually, what time is it? Should we take a break? Actually, let's take a break for let's keep the break short because that way we get to leave earlier. Why don't we take a quick 10-minute break? So right now, let's try aim for like 8:41, 8:42. When we come back, we'll walk through this paper and momentum back test, and then we'll just call it a little early today. the point of what I'm trying to do in this class is that the idea is to just like take baby steps towards basically showing you what people do in the quant trading industry. And a lot of that comes from just taking paper steps at a time and then just realizing that what people actually do is super easy. So remember what we're trying to do here. We're trying to form a long short portfolio and do all this stuff to verify a trading strategy seems, at least in the sample, to be robust, and then to sort of understand exactly why the strategy will occur in a way that we think makes us think that it might happen in the future. So, and then momentum is just a very simple idea. We still don't know why it works, but past returns predict future returns. There's lots of different theories. And it's very simple. You have a historical return over a window, in this case, 11 months. You wait 1 month, and then you hold it. Okay. Now, this is not the original paper that wrote it, and these are actually not the original authors. But the reason why we go over this version is because it's a little bit simpler than the way it's elsewhere represented. This is probably the simplest version I've seen in a published paper. And I'll show you how there are variations, both in practice, but also among academics. This paper also makes a couple of different interesting observations about the nature of momentum. Kent Daniel, the guy at the top right, is this guy at Columbia. Toby Moskowitz, the guy at the bottom right, he is a professor at Yale and is a consultant to AQR. And I think anecdotally, I've heard that he really helped AQR understand momentum during the financial crisis. And so that's where the observations of the paper may or may not have come from. I don't know. Now, what I'm going to do is slowly read this paragraph with you guys. There's probably like one more paragraph in the paper that, for the purpose of exposition, I guess I didn't include. But I just wanted to sort of show you that the way that people describe academic paper, signals in academic papers, just give you some flavor of that. And we'll do this, a few times in the class. But essentially, the point of this is that it's really easy to actually take what sounds like, oh my gosh, it's a published paper, or it's a paper in the CFA journal or whatever. It sounds like quantitative finance, sounds intimidating, but it's actually really easy. So the first thing should be familiar to all of you. We take our principal data from the Center for Research on Security Prices. This is just a 300 megabyte file in your course folder, right? And then on WRDS, you type Alan is the coolest 123, you click, and then it's yours. Easy. Okay. And then the second sentence says, we construct monthly and daily, so they do a daily version of this, momentum decile portfolios. Okay. Decile portfolios. What decile portfolios means is they take things into 10 buckets, kind of like I've been saying, sort of like, well, I don't know if 10 buckets is the right thing to do, but this is how everyone does it. And so in fact, they just say we do decile portfolios, where both sets of portfolios are rebalanced only at the end of each month. What does that mean? It means that they rebalance, meaning they trade once a month. Okay, so that's this idea of monthly convention. Not saying that that's how you should do it, just saying that that's how they do it. Okay. Now, so to this point, it's basically what I told you, that it's just monthly rebalancing into 10 buckets. Okay. The universe starts with all firms in the New York Stock Exchange, AMEX, or NASDAQ as of the formation date, meaning end of the month or whatever it is. And what is that? NASDAQ was then tiny, but also based in New York. So presumably, if you're a guy dressed like the Monopoly man and trading stocks, you can just go from one end of New York to the next, trade stocks. American Exchange is also New York, right? So they assume that you can only really trade in New York because you don't have a phone, you don't have internet, and so on. And so you're only bound to New York, which I think is reasonable. Okay, so we utilize the returns of common shares. In CRIS, there's a field called share code. In FactSet, it's just called share type, and you write it as common. The alternative to share code 10 and 11 is they exclude ADRs. So for example, American Depository Receipt basically means it's like a stock from a foreign country that is cross-listed. So for example, Alibaba was an ADR in the US. even though it's like, and it's simultaneously listed in Hong Kong, or it was later listed in Hong Kong. But the point is that, and then there's also preferred shares and ETFs. So there are like certain things that you can find on stock exchanges which don't count as common equity. There's preferred shares and other things, but for whatever reason, we focus on common shares. That's fine. They have to have a valid share price, valid number of shares as of the formation date. The reason why you could have missing shares, sometimes people suspend trading. Sometimes it might be like a new company. So basically, if it's IPO, it may not have a historical date or something. Okay, so far so good, right? It just says, if you translate it to code, basically what it means is the price last month was not missing. So that's not that hard. I'll show you how to do that very easily. And then basically, they have this thing where they have none missing data. I'll translate to that. But basically, if you're calculating returns over an 11-month period, they want 8 of the months to not be missing. This one doesn't really matter. If you ignore it, it doesn't matter. You can have 11 months none missing. 8's just some number they made up. It doesn't really mean anything. But to this point, they're just saying, hey, we got the data from New York, and we're going to do this monthly thing. To form the momentum portfolios, we begin by calculating ranking period returns for all firms. The ranking period returns are cumulative returns from the close of the last trading day of each month. Firms are ranked from the cumulative return from 12 months to 1 month before the formation date, e.g. cumulative returns from month T-12 to T-2. So that's these 3 sentences, which were written probably in not the best English, not the most simplest English, means cumulative return means you compound the return over this period from T-2 to T-12, okay? And basically, they have this stuff at the end of the last day or whatever. All that means is you just take the data in crisp. So what CRIS in most databases report is a close-to-close return. So basically, what that means is the return assumes that you traded at the end of the prior close. So in the CRIS file, which we'll show you guys, you just literally take the column called return, and that's all it is. At first, it sounds really complicated. Oh, how do I calculate the end of last close and all this stuff? Literally, they're just saying they take the column return, and they're just kind of like reiterating the definition. So all you have to do is just take a rolling 12-month return, 11-month return over the appropriate period. And I'll show you how to do that. It's 1 line of code in Python. It's awesome. And that's it. So if I were to translate that in out of gibberish, they also have one more paragraph, which I don't think I have in this version of the slides. Basically, if you just they have like prices greater than 1, things like that. Literally, if you just translate it into just bullet points, this is literally what it looks like. There's a field called share code in 1011. Sorry, I missed one. There should be. There's a field called share code that's 1011. And again, we'll just show this in code. There's a filter called hex code, exchange code, in 123. That's American Stock Exchange, New York, and NASDAQ. The price has to be greater than 1. I don't really know why the price is not greater than 5, because we talked about it. The bid-ask bounce or the bid-ask spread minimum across history is, what is it? It's 25 cents. But whatever, we can go with 1. We can also show what happens when there's 5. Sorry, it should be the price at T-1. So the last month price is greater than 1. The reason why it's the last month's price is because you trade at the end of last month. Because you trade at the end of last month, it's the price that's reported in a database is typically the last price of the month. So you want the end of last month's price. So the price last month is greater than 1. And then non-missing values for returns from 2 months ago, 13 months ago, market cap's not missing last month, and then at least 8 valid returns over this ranking period. I actually don't know what cases, why these things would ever be true. Like, why would you be missing a price from 13 months ago? I actually just don't understand. I guess it's like a recent IPO stock or something, but I don't really understand. But like, I guess it's just what they did, and then they just wrote it for like scientific replicability. But if you ask me like what these things do, I would say basically nothing. I actually just don't even understand. Of course, I know this because I've tried this many ways, but All I'm trying to say is that at least half of the stuff that they wrote is basically useless, and it doesn't really matter either way, like honestly. And it sounds like really fancy, like, oh, you have to be not missing any data from like 13 months. It doesn't matter. If you do it either way, with or without, ignore it, change it, doesn't really matter. Now, the reason why I picked this implementation, in addition to this paper making really interesting observation about momentum, which we'll talk about next class, is that it's a little easier than some other ways that people have implemented it. So if you look at the Fama French implementation, so Fama French, they put out the Fama French 3-factor, 4-factor, 5-factor model. They basically tell you what the best factors, risk factors to benchmark assets are, mutual fund managers. For a while, they were tracking, they still track momentum. Their implementation's a little more awkward. It's, they look at the top 30, bottom 30 of momentum, but they create 4 portfolios, one only among big stocks, one among small stocks, and they use New York Stock Exchange breakpoints. That's not super hard. In order to implement this, you would need 1 line of code. In order to implement this, you need another line of code, or 2 lines, I would say. It's not that hard, but it's like a little more like, I don't want to do it. I mean, we can, it's not that hard. I'll show you guys how to do that. I can show you guys how to do that too, but let's start with the simpler implementation. And then the second one's like 3 more lines of code. But anyway, the point is that what sounds like it's really hard is just a cookbook that can be broken down into each line or set of lines is like 1 line of code in Python. And you just have to translate from some nerd talk to like basically what is like the actual piece of code that they want you to do. And to be honest, half the code choices that they make are completely arbitrary. And so basically what I'm trying to say is not that hard. You don't have to follow their formula exactly. And then it's actually much simpler than it sounds. And so it's just like each one of these steps that, because basically what we do when we write papers is we basically write like lines of code in Python or R, and then we just like write up what we did and we make it sound smart. All I'm trying to say is that when you read a paper, it might sound intimidating. I don't know if it does, but when I was a PhD student, I thought code sounded intimidating, paper sounded intimidating. And then when I actually coded it up, it was like really simple. And so that's basically the point I'm trying to make. It's much easier than it sounds. So we'll go through the code next time, but I just want to sort of show you guys how this sort of works out in the case of momentum. So in the case of momentum, all we're trying to do is score stocks. All this stuff is we take a signal and we take the same repeat trading rule. And then we just try to say, okay, given the repeat trading rule, let's try to keep the trading rule simple and see what happens when we vary the signal. And in this paper, they even violated some of the trading rules that I told you about because their point was not really about trading. The point was about studying momentum. And I don't know, I guess they were lazy or something. I don't know. But basically what we see here is what they're really doing is they're saying momentum is the previous 12-month return, skipping 1 month. And what they're doing is they're ranking stocks based on momentum. What we're doing here is we're saying high momentum should outperform low momentum. And in between, we expect this monotonic ordering, okay? That's all we're really expecting. In the data, basically what that means is that every month you have different stocks in a momentum portfolio. And what you do is you just average that over time. That's all you do. So you have 10 different portfolios. A stock could transition from one portfolio to the next every month. And all you're doing is over time saying in that portfolio, if I took an equal weighted average of their returns, you just take an average in Python, or evaluated average, meaning you took return times market cap from the last month over sum of market cap. Very simple. What is the average return to each one of these buckets? And so you guys know how to calculate an average. How do you calculate one for each portfolio? You do like a group by in Python. So like very simple. And what you're doing here is just you're seeing what are those averages and those volatilities across the different portfolios, okay? So that's basically the first thing you do. In the end, in our hypothetical exercise, we are hypothetically trading the top 10 minus the bottom 10. So at the end, what they plot here is the high minus low. Now, this looks like a bunch of numbers. It's like, I don't know, what am I supposed to look for? But I guess let's train our attentions on the first thing. Is this strategy a good strategy? Well, if my score is good, what am I looking for? I'm looking for 2 patterns. First, I want the long to be higher than the short. right? That's what I would expect. Winner minus loser, winner meaning past winners versus minus past losers. This is an annual number. The annual number is 15% per year. Where does that come from? If you take the top 10% minus the bottom 10%, right? 0.31, 15.37, that's 15.07. Roughly, it's like rounded. Now, that's just high minus low. Now, what are we looking for in between? We're looking for something like if this was 10% arbitrary, it was arbitrary. What happens if I want to buy the top 20% because I'm super big as a trader and the top 10% is not enough? What I'm looking for is something that looks like this pattern. This is actually my implementation, in R. And then you just, most papers just plot it because people's heads explode when you show them that many numbers. But basically, all this is just that the numbers, very similar, plotted. And what you're looking for is just like this sort of stepping up, right? Why do people like this pattern? Well, first of all, I might have cut it, for instance, in the Fama French way at the 70th percentile, right? And the 30th percentile, or maybe I just go high or low. Why does that matter? Well, because, first of all, conceptually, so imagine that this were true instead, right? Suppose I had this like French fry, or this, I guess wrong color for a French fry. I'm a little hungry, sorry. Okay, I have this like French fry sticking out in the middle, right? So then you would say, oh, it's pretty clear that I understand the differences in returns, but if I have this French fry in the middle, you'd say, I don't know what the hell that is. But if I thought that momentum sorts stocks based on returns, then this looks a lot less ugly, a lot less good than if I had this French fry, this other French fry sticking out here. Then you'd say, oh, this signal, I mean, sure, the long is better than the short, but I don't know what's going on in the middle here. Maybe this momentum thing doesn't really, explain returns. And also, if I did high minus low or bottom 20% minus top 20%, it's not clear to me, given this picture, that would be a good trading strategy, right? So in other words, we look for this smooth monotonic pattern because I think intuitively you guys can agree that this graph is a lot less attractive than the one where it kind of could just go straight up, right? I think you guys can probably intuitively agree that's probably true. So it makes it look more like we understand what's happening, but also if we did arbitrary portfolio cuts at the corners, then probably we more accurately describe returns. Now, you can do this in numbers. They also plot volatilities, and then here this is a Sharpe ratio. This is already annualized. It's 15 over 26. That's roughly what is that, 0.58 or something? Ish. 0.58, let's say. Almost 0.6. And remember, the market, the U.S. equity market is about 0.4. Okay, so then that's much higher Sharpe ratio than the US market. Okay, now what is its alpha given its exposure? Its alpha seems a little high actually. I don't think it's because this is before momentum crashes in 2009. And the momentum eats it in 2009, so it's not this high. But if you did an annual alpha in pre-2007, pre-financial crisis, the alpha is 19% per year. But momentum eats it really hard in 2009. So I mean, this is like right before. And the beta is slightly negative, and actually it's a little more negative than this. I'll show you. It's a little bit different than QMJ, where momentum's negative beta is bad, whereas QMJ's negative beta is really good. But it's a very interesting story, at least interesting to me. I'll show you guys later. But its market beta is slightly negative. Okay. Okay. But basically, this is the thing we're looking for. We're looking for the long Sharpe ratio to be positive, the Sharpe ratio to be good, positive, and we're looking for this like monotonic pattern of because we don't know exactly whether we're going to cut at what level. And then we're looking for this P&L curve to be upward sloping and continue, because I'll tell you, and I'll show you some papers where the paper got published in an academic journal of high repute. And then if you plotted this, which they didn't, it kind of looks like that. It's like last 20 years, like, yeah, someone didn't ask for a plot. But basically, it's pretty clear it doesn't work anymore. Although there are variations of it that might still in the future. It's pretty bad though. But there are some pretty interesting academic papers that are published in never none of mine, of course, that would have this problem, but that basically if you plot it out, it just like stops working. Some papers just stop working. They're just like, and stops working after the paper's published. And that's because the paper was published, but they're somewhere during the sample. Anyway, but basically you want to look for this curve to continue to go up. There are some papers that just hide this fact. And then it's kind of funny. It should be minus the bottom 10%. I don't know why I wrote minus the bottom 5, but and then you do a factor analysis. You guys already know how to do this. In fact, you guys probably already know how to do the P&L curve and things like that. And we'll walk through the code slowly next time. This is an R, sorry, but basically back then the benchmark model was the 3-factor model. So that's, I'll explain what those terms mean, but this is the market risk premium. This is a value strategy that approximates value investing, buying stocks with low valuations. And then there's always this question of whether or not small stocks earn a high premium, which they did before the 80s, and that the size anomaly, quote unquote, has disappeared. There are explanations around that, but we can talk about them later. They're quite interesting, I think. And then anyway, this is a monthly alpha. And so if you take 1.017 to the 12th, then that's probably around the 15% that we saw earlier. It's lower than the 17% because it doesn't account for the momentum crash, the glorious momentum crash in 2009. Here's one thing that I think, so I think at this point, I think we all sort of agree that this is essentially what we did the first class. The only wrinkle to it is that we're looking for this pattern in the middle. That's it, that we're looking for this stable pattern because we don't know if long, short 10% is a good idea or not. Now, the only thing that I would say is a bit different is basically trying to understand what exactly the strategy entails economically. And we won't get through that full thing. We'll talk more about it next class. But the basic idea that I want to convey is it's really common, at least as a statistical procedure, to do what's called an event study. And the event study also has it's not sufficient to understand why a strategy does or doesn't work or what the economic mechanism is, but it is helpful for that purpose. And basically an event study is just a picture that tells you if you track the strategy over time, sometimes before the strategy and sometimes after, and definitely after, what happens to the temporal pattern of the price or the cumulative return index. So, and here's basically the hypothetical story. There's 3 versions to basically any trading strategy. And basically imagine this were your trading date, or it could be monthly, it could be daily, whatever. The pattern tells you a lot about what's happening. It's already labeled here. So imagine that my new colleague, Jack Ma, he would never do this, but he tells me the earnings to Alibaba next quarter. Okay, so day 0 is the day that Alibaba announces earnings. Now, Jack Ma would never do this. And of course, I would never trade on insider information, but suppose I did. Basically, there are 3 things that might happen. Earnings, the day that earnings comes out, is a highly visible event. So if people are paying attention to earnings, what you might expect to see is that the day that earnings comes out, the market pops or drops or whatever. And then basically, as people are paying attention, they say, generative AI from Alibaba is gonna, be awesome. All right, so then they guide it up, boom, right? And then if the market's paying attention, then it's just flat, right? Because it's already been priced in immediately. Now, and so that's what you call an efficient response, okay? So typically, if there's a news event, the market captures that news event, and you somehow can come ahead of that news event. That what you would say is basically you probably had some news. So oftentimes with earnings, you don't have to be. Oftentimes what happens with earnings, if you have positive earnings surprise, earnings basically gets priced immediately recently. There used to be this thing called an earnings drift. I think that, to be honest, I think it's gone. But basically nowadays, it's just like priced in immediately. Now, there's another story that you can imagine, which is that for some reason, people are not paying attention to Alibaba, right? And even though this is good news that eventually ends up here, people just kind of ignore it because maybe that day there's a macro announcement or something. There's some evidence that like investors sometimes don't pay attention to earnings announcements. Some days there's macro news. So basically, you can imagine that price adjustment's kind of slow. It probably wouldn't be 30 days slow at part of this graph. You can imagine something like it drifts up. Or you can imagine that people are too excited and then the stock goes up, but maybe even so far up that it's outside of fundamentals and then eventually comes back down a few days later. So this is what we call a reversal pattern. So think about like basically in your head how this would work. If the market's paying attention, it gets priced immediately. If the market's not paying attention, it gets priced slowly. If the market's paying attention, but they get a little too jolly, it's going to go up in reverse, right? And so there's a little bit of a different interpretation to each one of these that tells you a little bit maybe about why the strategy may or may not work. And then also the second implication of this is that there's an optimal trade timing that tells you how long, if you want to avoid trading transaction costs, or you want to get the optimal return, how long it takes for the full returns to be realized such that you can make efficient use of capital or whatever. So here's what it looks like for momentum. And it's pretty weird, actually. So momentum at the far left, it shows you the cumulative return in event time month by month, meaning basically what happens as you go from month to month. And the cumulative return that's being plotted is the long-short portfolio difference, meaning that your strategy, if you held onto it, continues to be profitable as soon as this thing goes up. What it shows is that basically at different periods of history, there's a robust fact that the momentum portfolio, it's based on last 12-month return. Somehow, it keeps going up for another 12 months, right? So this is about the 13-month mark. Oddly, the difference between long and short portfolio just reverses. Like it's just very weird. In more recent periods, it takes it's in more recent periods that reversal period is actually slower. It's very weird. In earlier periods, the reversal period is actually shorter, but in general, this reversal period is like 6 years, or sorry, 5 years. It's really weird, right? It's neither. It's like initial underreaction followed by eventual overreaction. It's very odd. So people find this very puzzling. It's probably not like efficient pricing of information. It's just there's something odd. Now, I can tell you probably a risk-based explanation and also tell you a behavioral explanation, but most people, generally speaking, when they see this graph, if they say, aha, this is evidence that markets are stupid. And the people who define markets are stupid. Now, I mean, there are behavioral stories. One simple behavioral story is simply that, so imagine that you have a stock like NVIDIA. It's been doing well. People are sort of not really paying attention. People sort of slowly pay attention and they get exuberant. So right now I'm guessing NVIDIA, well, this is my personal opinion, is probably somewhere like here. And so I think it's probably a little overpriced, but I don't know. I've been wrong about this many times. But it's probably one of those, right? You think about NVIDIA now, because the whole GPT thing or whatever, it just people reacted slowly. People probably, is it $1 trillion stock? I don't know, but maybe. This is an example of something where it's a little bit of different texture. This is an alternative data trading strategy from using data from a company called Closing Bell. And it's part of a marketing deck for its trading strategy sold to hedge funds. This is basically what happens when people in Closing Bell say buy versus when they say sell. For whatever reason, there's a set of sophisticated traders on Closing Bell whose trade recommendations seem to have some outperformance. This is what happens to the return adjusted for the market. And I can explain how that's done later, but basically it's just you take the return and then you regress against the market and take out the residual. And basically the first day there's something that happens, there's a big pop. First day someone says sell, there's a big drop. And there's a little bit of drift after, but in general, it's pretty stable. That means, first of all, tactically, most of the return is done immediately. It also means there's a little bit of a drift, but this is probably more consistent with like the people in closing bell announcing the news or information that they have right before the rest of the market finds out, and the information is very short-lived. So it tells you, first of all, that probably what the closing bell guys were doing is they're implementing, they're basically tracking announcements, like and that secondly, the information tactically short-lived. Whereas in the case of momentum, if you trade it for 3 months, 6 months, 12 months, it doesn't really matter, right? And the information, whatever it is, it's unclear, but whatever is explaining this is very different than what's explaining this, right? This is more of a news story for sure. This is, I don't know, it's been the debate of like 30 different papers. I'll show you all the different theories. I mean, at least the ones I think which are interesting. But it's clear what's going on here is very different than what's going on here. And it's also clear the optimal timing is different. And I'll show you guys how to do an event study and all these things in code. So I promised I would let you guys get out early. This is where we stopped in the last class. If you guys want to code along with me next class, what I recommend you guys do is set up your VS Code or Jupyter environment. And then I'll be coding out of VS Code, which is very similar to Jupyter. And basically, yeah, just next class, I'll be coding and showing you all these steps. So, yep. Okay, thanks for your attention and have a good rest of your weekend.